3, 2. How you doing?
All right. We're here again.
Same bat channel, same bat time. Every week.
Not the same week as last week, though. Holy moly.
No? What happened this week?
Pretty big week. Market's up quite a bit. Hopefully it holds in there on Friday. It's about 11:30 in the morning as we're doing this, and market's off a little bit, kind of flat. It's to be expected after
Old.
Yeah.
Old.
I mean, it's been quite the week where it's C funds up over 3% for the week. So going to be a lot of interesting stuff in the newsletter this weekend. So if you're a subscriber to the site, you definitely want to read the newsletter this weekend because we are approaching some pretty important levels on a daily basis, Fibonacci levels. And
Well, that Fibonacci guy.
Fibonacci's always right around the corner. So the 0.618 retracement level in Fibonacci is the most common retracement level, right? So we hit that sometime, I can't remember which day this week, paused there for a minute, and then gapped up on Thursday right through it. So pretty solid. When that happens, it means there's a lot of strength behind the rally. And the next and last Fibonacci level before we get up to the prior high is the 786, and that's where we are paused at right now. We've been there for most of today. It basically moved up to that level and has been going sideways for the day, so we'll see what happens. At any rate, so there's always good Facebook questions, and a lot of these are kind of repeated, but they're always good to kind of go over. So this one's
and there's little nuances too, right? There's differences. So
yeah.
Sometimes we'll cover kind of the same topic from a different direction.
Yeah, this is a good one. And then we'll go over what happened this week, and then kind of a deep dive into the F fund. We've been talking a lot about the F fund. I know a lot of people don't like it, don't really understand how it works. So we're going to kind of go over how it works and why it's different from the G fund. Because a lot of people batch the F fund and the G fund together thinking they're both bonds, but in reality, they actually go in opposite directions of each other. And then we'll take a look at the S&P 500 versus, imagine it. So the S&P 500 is a capitalization-weighted index. So the bigger companies get more influence in the price, which is a big part of the reason why the Magnificent Seven and all that are the ones that are driving the market higher. But the RSP is if all the companies in the S&P 500 were weighted the same. So what would it look like? What would the S&P 500 look like if,
Right.
Apple was weighted the same as whatever the 500th company was, right? And TSP fund charts. Okay, so this is the 2 move a month rule and the noon rule. It's complicating a little bit. Once you get it, but it can be confusing. So can someone explain how your account value is affected if you make an IFT, right, a reallocation, if you make a move before noon? I understand it will be executed at market closing of 4 o'clock. That's right. If you were 100% C and made the move, made the before noon move to 100% G. So this person wants to go from 100% C to 100% G. If the market closes, if it's a bad market day and the market's down 2% that day, will you not feel the loss because it's all in the G at market close? Yes, you will take that loss because you were 100% C. You asked the TSP to move you to 100% G. That doesn't take effect until 4 o'clock, until the market closes that day. So whatever happens during that day.
Right. That's what you get that day no matter what.
You get that no matter what,
Yeah.
right? So like if that was on a Friday, let's say, and you put that interfund transfer request in at 10 in the morning on a Friday. If the market closes down 2%, you're going to take that 2% loss. But whatever happens on Monday, if the market goes up on Monday, you're going to get those gains. If you did that reallocation at 1 o'clock in the afternoon on Friday, right, you're going to get whatever the losses were on Friday, and then you're going to get Monday's closing price.
Right. And then it'll take an effect.
Then you'll get Tuesday's whatever happens.
Tuesday is your new allocate. Is It's not really that hard once you wrap your head around it, but it is a little hard to accept that, well, I made the change by noon, so that means I get it that day. Yes, but it doesn't happen until after it closes.
Right.
That's the key. Right. You get the closing price, and then they reallocate it.
Right. You have to ask for it in advance.
Right.
Right. And you have to ask for it before noon. So it gives them time to process it, and you get that day's closing price. I mean, I don't know how else to explain it.
Yeah.
Once you get it, you understand it.
Yeah.
The noon rule is a big one. It's
the day you change it, that's going to take effect the morning of the next day. It's another way to look at it.
Yeah.
Right.
I mean, there's all kinds of ways.
And I'm just trying to think of different ways to come at it for people to go like, oh, okay, so I'm not going to be in G that day, even though I did it by noon. I'm actually going to be in G when our market opens up on the next day.
Right.
Yeah. So that's just the opposite way of explaining it.
Yeah. But yeah, however you see it, but that's
whatever it takes to soak in. Yeah. It's a little frustrating because
it's the worst. It's the worst of the two rules.
Yeah. It's mostly frustrating because that made sense 20 years ago because of technology.
Yep.
We're at a point now when we can make trades within seconds, if not minutes.
Yeah.
You can't tell me you couldn't do it within an hour.
100% you can do it. I mean, the mutual fund window.
Don't want to.
You can do it, right. They just don't want to. In the mutual fund window, you can make trades right up until 4 o'clock.
Yeah. So that just means it's possible. It's just they don't want to do it.
And in the mutual fund window, it's the same as TSP in that mutual funds only have closing day prices. So you're going to get, if you make a change in the mutual fund window at 10 o'clock and the market goes down, you're going to go down with the market because mutual funds work. They only have closing day prices. It's the same as TSP. So why couldn't TSP let you, wait until the end of the day right before it closes to do the trade? They're doing it on purpose.
Yeah, the noon rule is outdated, antiquated, whatever the right word is. The 2 moves a month, they're trying to keep you from day trading or whatever you want to call it, multiple moves all over the place and, protect you. I can buy into that.
Yeah.
2 moves a month. The noon rule's got to go.
Yeah, the noon.
Write your congressman.
Yeah, please.
Congressperson.
There was another question in there this week also that actually went to the 2 move a month rule. And that one's a little bit more complicated and people have a hard time with that one too. We call it the 2 move a month rule. It's not 2 moves a month. You could move your money every day, every single day. The first time you move, no matter what you do in a calendar month, no matter what you do, that's move number 1. The second move, no matter what you do, that's move number 2. Any move after that, and you can do it every day after that, till the end of the month, but any move after that, you can only put a portion, you can only move to the G fund. You don't have to move 100% to the G fund. If you've done your 2 moves and you're sitting at 50C, 50G, the next day you can make it 45C, 55G. The next day you can make it 40C, 60G.
You just start creeping your way into G.
You can do it however you want.
Yeah.
Now you can't move into an L fund at that point. You can't move into the F fund or the C or the S or the I.
Any other fund.
You can't put money into anything else other than the G fund.
Yeah. And that's basically just to protect you. At any point during that month, you can go to the safety of the G.
Yep.
Again, I don't disagree with that.
No, that's good.
The two moves, and then you can only retreat to safety to the G. Not a lot of people do that, right, which is a shame because sometimes it's better to go to the safety of the G and let it ride it out and then get back in once you've got your plan together.
Yep.
But a lot of people are like, why would you go to G? And we don't have time to explain that right now. If you're watching this, please don't be that type of person. Why would you go to G? Why would you go to F?
It's a tool, just like anything else. I'm going to talk about the F fund as a tool, but the G fund, you don't want to spend all your time in the G fund unless you're, if you're retired and you're going to use that money for a down payment on a house in 6 months, you probably want to have it in the G fund because you don't want to worry about the risk, the downside risk.
Right, the market fluctuations.
Yeah. All right. So hopefully that helps the 2 move a month and the noon rule. All right. So this week, Monday, nothing particularly interesting. No economic news. Market's pretty volatile. Closed a little bit higher. Tuesday we have PPI. It feels like that was a long time ago, but PPI comes out on Tuesday. before the open, it showed inflation is decreasing. Okay, so and it came out. The number showed that inflation was decreasing more than expected. So that supports this idea that the Fed is going to be able to start cutting rates in September. So on the idea that the Fed's going to be able to cut rates, the market rallies, and it closed above its 20-day moving average line. Okay, so that's good for the market, but it's bad news for the economy, really. It means things are rolling over, right? The economy is contracting. Then on Wednesday, the CPI comes out before the open, and that's in line with expectations. So market kind of shrugs it off. Some morning weakness, rallies for the rest of the day. Finishes a little bit positive, but basically flat. And then Thursday, we get the latest jobs report and the retail sales number. So a much better than expected jobs report, which basically means there was a lot less people claiming that they were unemployed, right? So that's good for the economy, right? It goes against the idea that the Fed is going to lower rates. It's good for the economy, and still the market rallies. It was a really big rally on Thursday. S&P was up 1.6%. So that was good news for the economy and good news for the market. It rallied. On Tuesday was bad news for the economy, but somehow also good news for the market, and it rallied. So if you're trying to game this thing, if you're trying to anticipate which way the market's going to go, because you say, okay, well, if the market goes up when the economy is weakening, because it bolsters the idea that the Fed's going to cut rates, and you trade based on that, you might be right. But then on Thursday, you'd be wrong, because if a better than expected job report means that the Fed should not cut rates in September. So anyway, sometimes good news is good news. Sometimes good news is bad news. All you can do is follow price. It's the only thing that matters. We get a little bit of conflicting data on Friday. Housing starts. So housing starts are when you break ground on a new residential house. It's not commercial real estate, it's residential. And the number begins when you break ground on a new house. So housing starts were down 6.8% this month. Last month, they were up 1.1%. So that's a big move. It's basically saying people aren't at least since last month, there's a big decline in the number of new homes that are breaking ground. Okay, that's obviously not good for the economy, or it's a stat that shows the economy is weakening. But at the same time, the Michigan Consumer Sentiment Report comes out, and it ticks up a little bit to 67.8 from 67.4 last month. So apparently people are feeling a little bit more confident about the economy than they were last month, even though they're buying way less houses than they did last month. So conflicting data didn't move the market too much, at least as of noon or so. Market's basically flat. It's down a little bit, but nothing major. Okay, F fund. So it's a tool, right? Just like the G fund. But I pulled this off the TSP website. So why should I invest in the F fund? This is what the TSP says. F fund investors are rewarded with the opportunity to earn higher rates of return. The opportunity, not guaranteed, opportunity to earn higher rates of return over the long term than they would from investments in short-term securities such as the G fund. So generally, that's true. It hasn't been true since 2000, right? The F fund has been in a steady decline since it peaked in 2000. Overall risk is relatively low in comparison to certain other fixed income investments in the market because the F fund includes only investment-grade securities. So it doesn't include high-yield bonds. That's what they're saying. So it's basically stable. You're not going to get as high an interest rate as you would if you were buying high-yield bonds, but you got a lot more stability and less volatility. So am I okay with market and inflation risk? So inflation risk, we all know, is a big deal right now. F fund returns move up and down with the returns in the bond market, right? F fund investors are also exposed to the possibility that principal and interest payments on the bonds that comprise the index will not be paid. That's credit default risk. This stuff is all about bonds, really, or if the F fund investments do not outpace or grow enough to offset a reduction in purchasing power, which is inflation. So your F fund investment is also exposed to prepayment risk, which is the probability that if interest rates fall, bonds that are represented in the index will be paid back early, thus forcing lenders to reinvest at lower rates. All that stuff really pertains to actual bonds. It doesn't pertain to what the majority of the F fund is, which is U.S. Treasuries and Treasury kind of components. And we're going to get to that in a second. So how can I use the F fund in my TSP? In periods of falling interest rates, okay, which is now, for the rates peaked at 5%, right? I can't remember when that was, last summer maybe? Rates peaked at 5% and they've been falling. So the F fund will experience gains from the resulting rise in bond prices. So when interest rates fall, the price of the F fund goes up. So in the long run, you may expect F fund returns to exceed those of G fund. However, you should also expect greater price volatility, right? Up and down movements. A retirement portfolio that contains stock funds like the CS&I funds along with the F fund will tend to be less volatile than one that contains stock funds alone. Okay. So this is what's in the F fund. This is actually the holdings of the aggregate bond index. Okay. The F fund, the goal of the F fund is to move up and down on the same percentage basis every day as the aggregate bond index. And so iShares runs the aggregate bond index, and this is what the holdings are. So you get almost 50% is U.S. Treasury bills. Okay, so the vast majority is Treasury bills. And then you got Fannie Mae, Freddie Mac. All these are federally insured bonds, okay, as opposed to bonds in Bank of America, J.P. Morgan, Morgan Stanley, Wells Fargo. So, but they're relatively really small weighted, right? So, yes, the market risk and the prepayment risk and all that kind of stuff that they were talking about before, that really applies to these bonds that are part of the aggregate bond index, but they're nowhere near weighted as much as the secured government treasury bond side. So the thing that you really follow is what happens with the 10-year yield. Okay, that's kind of the best way to see what's going to happen with the F fund, because that's what we're talking about here. So this is a chart of the 10-year treasury note yield. Okay, so yield peaked back here in September 1981. Okay, so this would have corresponded when yield is high, the price is low, right? Because bonds work inversely. Yield is inverse to price. So I don't know what the F fund obviously didn't exist back then in 1981, but if it had, it would have been an all-time low in the F fund. So then you go forward from 1981, it doesn't go in a straight line, but you got consistent lower highs and lower lows. So you have this long-term downtrend that finishes in August 2020. So the downtrend in yield is an uptrend in price. So the F fund has been in an uptrend since 1981. And it bottomed down here, right? There's a theoretical maximum, basically, to the F fund, because unless interest rates are going to go below zero, which they have in other countries, but they haven't in the U.S., at least any time in the last 100 years, when rates get down to zero, that's as high as price can go. So once rates bottomed here in 2020, and the Fed started this rate hiking cycle, and bonds started moving higher, the F fund goes down because yield is going up, so the F fund goes down. So we've had this huge, this is a logarithmic chart, right? So it shows the importance of this move up in yield. This huge move, you don't see anything, all these other interest rate hiking cycles, they're nowhere near as big as this. Okay, so the F fund got clobbered since 2020. And so going forward, right? The expectation would be we get interest rates pull back and then continue higher, kind of like this was coming down. It should go back up on the other side. It doesn't mean it will. It's possible that rates come down and we keep on, keep coming down and years keep going by and it's like that. And this ends up being a blip and we keep going down, trickling back down to zero again. I mean, who knows? But that's where we are right now. And we peaked here at 5%. So for the past year or so, rates are coming down. So if you zoom in and look at it and compare it to the F fund, you got yield in whatever that is, magenta, and the F fund in black. Okay, so as yield goes up, the price of the F fund goes down. Right? When yield goes down, the price of the F fund goes up. So as yield has done this 1, 2, 3, 4, 5, the F fund did a declining 1, 2, 3, 4, 5. Okay, so now if you follow yield to figure out which way the F fund is going to go, this is what the analysis of yield looks like. So the yield bottomed down here in 2020. We got this 1, 2, 3, 4, 5 L8 wave pattern where it peaked out at 5% in yield. And now yield is coming back down, probably in this ABC corrective pattern. So if we get, yield comes down, the Fed cuts rates, but the economy doesn't collapse, that's the soft landing scenario. And yield comes down somewhere into this area of about 3 to 3.5%. Okay, and then it starts moving higher again. If the economy is collapsing and the Fed's cutting rates in a hurry to try to put a floor under the economy collapsing, then yields come down much further. Right? There's a lot of people that think yield's going to go back to zero. I don't think that's going to be the case, but it shouldn't get below the top of the one wave. Okay, if this 5-wave LA count is correct, this should be as low as yield can get. So the first target is right here, with down here being a possibility. So that's what it looks like for yield. Then if you just flip it and look at the F fund, that tells you, this C level right here, this A equals the same length as C. So here you got A equals C, which gives you the F fund up here at about 103 or 104. So you got this much room on the F fund to the upside, and then potentially all the way up here to 113 if the Fed really cuts rates in a hurry because the economy's tanking. If that happens, it's probably going to be a 2025 event, but we'll see. So that's the rationale behind the F fund. When yield goes down and the Fed is telling us they're going to lower rates. Okay, so they're giving you the answer. We're going to lower rates. When rates go down, price goes up. So the F fund at this point, like when they said at the F fund may give you an opportunity to outpace the G fund, in this case it is going to. It's the math. It's not. You don't even have to guess about it. I mean, anything's possible. Is it possible the inflation goes back up and the Fed has to raise rates? Yes. If that happens, the F fund's going to roll over. It's pretty unlikely, but is it possible? It's possible. The other thing is the G fund. So when rates go down, the rate of return of the G fund is going down. So you're never going to lose your principal in the G fund, but the interest rate that you get declines with rates. So as the rates come down, the rate of return you're going to get in the G fund is going to go lower. All right. I know that whole thing was pretty wonky, but it is what it is. The F fund is a really good tool sometimes, and right now, as of this week, the C fund's doing great. S fund's coming back a little bit. That's fine. If and when it starts to roll over, the F fund is going to be a really good choice for a certain amount of time. All right. So equal weight S&P versus the S&P 500. I started this back down here at COVID. So this is the COVID low. The S&P 500 is the red line. The equal weight S&P, equal weight is the black line. So all I kind of wanted to show is when tech is really outperforming, when tech starts really kicking into high gear, it starts, the market cap grows, and it doesn't have to be tech. It could be anything. If one sector of there are 11 sectors that make up the S&P, if in this case it's tech that people started really investing into, and it overtook the overall index. So the black line is if all 11 sectors were equally weighted. And if that was the case, the equal weight was outperforming the S&P, because back here, tech, I'm going to assume it was tech, wasn't performing as well as the rest of the market. Okay, so it was pulling the market down relative to the overall market. And then right here, this is why I put that green dotted line, that's when everything kind of started to change, because the equal weight started coming down, but the regular S&P did not, didn't go down then. And then it started, this line, is going up at a steeper angle than this line. So basically tech is starting to really take over here in April of 2023. And then eventually they flip, right? And the whole AI trade got going, and that just shows the amount of outperformance that is the result of the Magnificent Seven. But it's not always like that, right? Obviously back here, it wasn't like that all the way through here. So tech is not always the place to be, is what I'm saying. But when it is, it certainly is. All right. TSP fund charts. So C fund, we put up this chart kind of all the time, so I just added this one piece to it. This is a weekly view of the C fund, and this is the 20-week moving average line in blue. And so these corrections that we have, a lot of the times they tend to be a 10% correction. So this is the most recent one we had, right? We peaked in July, came all the way down, just almost 10% at the low. Last summer was longer, but it did the same length, right? 10%. And we had two 10% moves in that 2022 bear market. So a lot of times you get a recovery at that 10% point. So can you come down 10%, have a recovery, and then go to newer lows? Yes, absolutely, right? But a lot of times you'll get a bounce at that 10% level, which is what we got this time. Came down 10%, and we're in this bounce. So the big question is whether or not we get back above the previous high, or does the market roll over from here? So 10% is just something as a guide to have on your radar if you're trying to do if you wanted to do like a swing trade. If the market's down and we get below that 20-week moving average line and it keeps going down at the 10% level, you might say, all right, this might be a good time to jump in and do a swing trade. S fund, we had this big breakout from this triangle consolidation. Breakout failed, came way below. If it had only came down to the point of the triangle, that wouldn't have been so bad. But last week was a problem. And then it reversed and came back up. So now we're pretty much, I would pretty much call that the channel we're still in. Call this an overshoot, and we're still, we got to break outside significantly above that 2100 level for the S fund to keep moving higher. I fund we've been talking about for a long time. This 82 level had a triple top in 2021. We kept hitting it here throughout 2024. And the 20-week moving average line was pretty good support, but we lost it 3 weeks ago, and then it came down again last week, and then this week, maybe we're making another run at 82, but until it gets above that 82 level, I fund is not the place to be. And the F fund we talked about. So this is a long-term bottoming pattern. You got the left shoulder ahead, a right shoulder, and this is the neckline. We broke above the neckline 3 weeks ago, did a little bit of a retest last week, and it's kind of consolidating this week. It certainly looks like the F fund wants to move higher. The Fed is telling us it's going to lower rates. The F fund is the easiest trade right now for sure. All right. Questions.
As always, if you have questions, you can put them in the comment section wherever you find the video. If there isn't a comment section, you're stuck.
Yeah.
No, you can email us at support@growmytsp.com, and the support team will get it over to us. If you guys like it, share it with your friends. If you don't, share it with your friends.
Share it with your friends. If you want to put them to sleep on this one, probably share it with your friends.
It's always good info. It's always something you can learn. I hope you guys have a great week, and we will see you next time.
Out of here.